Okay, let's talk about SanDisk. Because right now, in early 2026, you'd be hard-pressed to find a stock that has Wall Street more divided. I mean, the stock has gone on an insane 1,200% run in just 1 year, and it's now sitting around $640 a share. So what's the deal? We're going to dive in, because this story is more than just about a tech company. It's a fantastic case study in how we all try to predict the future. And really, the entire fight over this stock boils down to this one question. Is SanDisk a structural bargain, a company that's been fundamentally changed forever by the AI revolution, making it a steal even at this price? Or is it a classic cyclical bubble, a company that's hit its absolute peak right before a massive, spectacular crash? Believe it or not, the answer completely depends on how you decide to look at it. And this right here, this is the heart of the puzzle. If you look backwards, using a metric called trailing PE, the stock is trading at over 200 times its earnings. That looks crazy, wildly overvalued. But if you look forward, using a metric called forward PE, analysts think it's trading at just 15 times its future earnings, which looks like an absolute bargain. So how can both of these things be true? Well, it all comes down to two totally different ways of valuing a company. Let's start with trailing PE. Think of it like this. It's like judging a runner based on their race times from last season. It measures the stock price against the real, actual, in-the-books earnings from the past 12 months. It's a fact. It's history. Now, for SanDisk, that's a problem because they had a messy year with some restructuring, so their past earnings were tiny. That's why that trailing PE number looks so gigantic. But we don't invest based on what happened last year, right? We invest in what we think is going to happen next year. And that's where forward PE comes in. This isn't about last year's performance. This is about trying to guess how well that runner is going to do next season based on their brand new, super intense training schedule. It's a forecast, a story about the future. And for SanDisk, that story is everything. So let's get into the optimistic view, the bull case. This is the story that has sent the stock absolutely rocketing to the moon. The people who love the stock are all saying the same thing. This time, it's different. SanDisk is not the same old company it used to be. The bull argument goes like this. The AI boom has created this bottomless black hole of demand for the kind of high-speed storage that SanDisk makes. They argue the company has transformed from a classic boom and bust business into a reliable structural growth story. And they're pointing to these new multi-year deals with the hyperscalers, the huge tech giants building all the AI data centers, as proof that they're locking in revenue for years to come. In their eyes, SanDisk isn't just making a commodity anymore, it's essential AI infrastructure. So the whole thing, that entire beautiful forward-looking story, it all hinges on this one single number, $39. That's what analysts are projecting SanDisk's earnings per share will be in fiscal 2026, an explosion from just a few bucks to 39. And look, if you believe in that number, then paying $640 for the stock today is an absolute bargain. But what if you don't? All right, let's flip the script and look at the other side of the coin. For the bears, the people betting against the stock, that low forward PE isn't a bargain. Oh no. To them, it is a classic textbook trap. They think history is about to repeat itself and it's not going to be pretty. You see, historically, the memory chip industry is just vicious. It's all about boom and bust. When times are good, like now, demand is off the charts, prices are high, and earnings are amazing. That makes the forward PE look super low and attractive. But that's almost always the moment of maximum risk, because those peak earnings usually have nowhere to go but down. The bears are convinced we are standing at that exact peak right now. And it's not just a vague feeling. There's a specific threat on the horizon, laid out by short sellers like Citron Research. Here's their thesis. They argue that SanDisk's competitor, Samsung, is getting ready to do what it always does, reclaim its market share by just flooding the market. If Samsung unleashes a wave of new supply of NAND memory chips late in 2026, the basic laws of economics say prices will crash. And if that happens, that projected $39 in earnings for SanDisk could basically just vanish. So here are the two stories side by side. You've got the structural bulls. Their worldview is this time is different. They see AI creating endless demand, and the big risk is missing out on the next Nvidia. Then you have the cyclical bears. Their worldview is this is a classic peak. They think the AI build-out will eventually slow down, and the big risk is buying at the absolute top of a cycle. One person's bargain is another person's giant red flag. So, how do we make sense of all this? Okay. Let's step away from the high-flying growth speculation for a minute. Let's put on a totally different hat. Imagine you're not a trader trying to make a quick buck. Imagine you're a pension fund manager. Your number one job is not to lose money. From that much more conservative perspective, the potential reward is interesting, sure, but it's not the main thing. The main thing is the reliability of the forecast. Your entire focus would be on one question. Just how much faith do you really have in that $39 earnings number? Is that number a prophecy written in stone, or is it a very, very optimistic guess in an industry that's famous for being unpredictable? And that brings us to the final, and I think most important, question. Let's stress test this thing. What happens if the bulls are wrong? Not completely wrong, just overly optimistic. What if the AI supercycle is real, but SanDisk's earnings don't hit $39? What if they fall back to a more normal, historical average for a good year, something like, say, $15 a share? All of a sudden, that cheap stock you bought becomes incredibly expensive. So are you comfortable paying today's $640 price for that less-than-perfect reality? That is the $640 question. And for a conservative investor, the lesson is pretty clear. You always have to weigh the heroic promise of the future against the very real possibility of a painful return to normal.